So we've got a very special presentation today looking at principles that every investor should know. There's actually a book on it, and we have the author here. So he authored the book, 27 Principles Every Investor Should Know. There may be more than 27, as we were just talking about, but these are 27 foundational principles. And don't worry, we're not going to rush through all 27 today. We're going to whittle that down even more, just looking at 8. But before we do that, I want to welcome all to the webinar. Obviously, Personal Wealth Strategies, we have our clients and friends here. We also have special guests from Sherpa Financial. So they made an invite to their client base. And so we want to make sure to welcome everybody from Sherpa Financial. Very, very happy to have them here as well. Now, before we dive into the presentation, I do want to go around and get a fun fact from everybody. So Steve, what is your fun fact for today?
First of all, hello, everybody. Thanks for taking the time to join us today. My fun fact is I was bitten by a rattlesnake about 9 years ago. And actually, a lot of times when we do when somebody asks, share your fun fact, about 5 years ago, I was doing this and somebody said, share a fun fact. And I said, I got bit by a rattlesnake. And somebody replied, did you live? And I'm like, I'm right here. I'm right here. So that's my fun fact.
All right. So you did live. That is good to know. Very fun. David, how about yourself?
Well, I'm a lifelong New York Mets baseball fan, and later this month, I'm going to fulfill one of the items on my bucket list, which will be to attend a spring training game to see the Mets play the Tampa Bay Rays at Clover Park in Port St. Lucie, Florida.
Awesome. Wow. Very good weather. Hopefully will be for that game as they get spring training. I actually saw the Pirates and Orioles played the bottom of the ninth without any umpires recently. So that's a fun little side fun fact. Not my fun fact for the day, I will share. But I have done so far this year 7,014 push-ups. So I know that to the push-up because I've set out to do 100 every day at the least. And then on January 11th, I started doing one extra. So I did 101, 102. So today is actually March 1, 150 push-ups that I will do today. However, I missed 41 day and then I skipped January 31st. So if you're trying to do the math and it's not adding up exactly, that's why. So I did miss some. So I am accountable there, but over 7,000 push-ups so far this year. All right. So Steve, let's get that presentation loaded up and we will start diving into the principles that we want to know today.
Excellent. Well, again, Justin, thank you for having me on and discussing the book, and thanks everyone for taking the time to join this and hear some of these concepts and principles behind the book. What you'll see on the upcoming slides is I'll give you a history of why this book even is in existence today, and also share with you what we refer to as 8 foundational principles. Obviously, in the title of the book, there's 27, but we think there are 8 that are foundational that really apply to everyone, and the other 19 are equally educational and important, but maybe not applicable in every situation. Let's see if I can get this thing working here. Okay. So again, you all are taking time out of your day to hopefully learn something, maybe catch a nugget or two. And I'm originally from Omaha, Nebraska, the hometown of Warren Buffett. Maybe you know who Warren Buffett is, the Oracle of Omaha, one of the greatest investors of all time. But I love this quote he has, and that is, someone sitting in the shade today because someone planted a tree a long time ago. And hopefully something will come out of today's webinar presentation that it will be that seed that will help you at some point in time later in your life, like a tree does for so many people. But the real reason why this book is even in existence is, quite frankly, I got tired of seeing headlines like you're seeing on the screen today, where people were taken advantage of, they were sold something, they wanted to believe that something existed that could help them, only to find out later on that they were let down. And you see these stories over and over again, where hardworking people who have great intentions, they want to save, are seeking advice from professionals and end up in a very bad state. And a big part of that, I think, is there's so much jargon that is put out from Wall Street. maybe that resonates with some of you, right? There's a lot of big words, big concepts, flashy presentations that doesn't always translate to Main Street. And in the 26 years I've been in this industry, I have observed people like you're seeing on the with Justin and David, who, they understand all that jargon and the technical stuff, but really understand that every one of us that are not in this industry, we have a plain spoken language, and we don't really resonate with the jargon. So bridging this gap between all the technical stuff that's out there, the jargon, the flashy things, and how can we repackage it so that it resonates into plain spoken language with Main Street America. And that's really the goal of the book, was how can we distill all of these great concepts that are out there that we've witnessed great advisors like Justin and David do, great academics that how they've dispelled some of the myths out there of how complicating investing can be. And can we take all that information out there that's working and helping the everyday person on the street have success when it comes to investing, and distill it into one book? So this project took about 2 years and started in 2017, actually. And when we started the project, my goal, at the time I had 3 daughters. They were 9 and 14. The 14-year-old are twins. That's why there's only 2 numbers, but 3 people. But I said, ideally, at the end of this book, it should look like something and read like something that my 9-year-old would want to read. So when you see the pictures on the right, hopefully that's very inviting, especially to the non-financial person in your household. And fortunately, to date, some of the best feedback I've received on the book is from the non-financial spouse or the children or grandchildren who say, whether they like the content, they want to pick it up because it looks inviting to them. Yet it's still a kind of a tough topic to grasp, this investing concept. So within the book are concepts that are born from 51 Nobel Prizes in economics. So each Nobel Prize, as you can imagine, is lengthy research, peer-reviewed, time-tested. Overall, there's decades of academic research, hundreds of practical examples. And for today's presentation, we're going to share with you those 8 foundational principles. I believe everyone on this call has either received the book or they will receive it at some point in time. But I'd love to get your thoughts, Justin and David, on this concept of bridging a lot of the jargon of our industry so it's applicable to Main Street America, and your observations and how you're going about that.
Yeah, I love it. And this is exactly why I wanted to have you here. And we do such an intentional job because typically there's, if you're dealing with a spouse situation, there's one spouse that will take the financial lead. They enjoy this stuff. They understand this stuff. They like to, talk in the jargon. And then there's one that tends to take a back seat. And we're very intentional here. And I know Sherpa Financial as well is in trying to draw in that other spouse, because at the end of the day, there are these basic core principles that they should understand and know. And we love the book in the fact that it's so inviting and very, simplified to what they really need to know at its core.
And I'll take it a step further. Even the financial savvy spouse, if that's the title for the other one, sometimes we think they know more than they know, or sometimes a piece of jargon can slip in there. So we're very careful. We're very diligent to make sure that we're not using jargon when we're talking to our clients, because our job is to be that liaison between Wall Street and Main Street, to use your analogy, Steve.
Yeah, great. Well, thank you. Let's dive into the principles here that we're going to talk about. So the first foundational principle, and it's actually the principle number 1 in the book, even, and because it's everything runs off of this concept, and that is successful investing starts with a plan. Without having a proper plan built around your life goals and having a very robust conversation up front with an advisor, or even doing a deep dive by yourself, if you don't have the plan, then most people are just throwing money at ideas and strategies without knowing where they're going. And that typically leads to an outcome that does not really, fulfill one's expectations. So every plan or every investor should start with creating a plan based on their life goals that covers multi-facets of your life, from work to family to financial values to maybe charitable inclinations. It covers a wide array of topics. Near the end of this presentation, I'll summarize that idea for you. The foundational principle number 2, and this is also very important, is to know the difference when working with a professional, who is a salesperson and who are the advisors. They're very different. Advisors, they put the investor in the center of everything they do, and then they find solutions or products that are best suited to reach the goals of that investor. Salespeople tend to be employees of companies. Those companies create products, and their job is to find people that fit into their products. Another way to say that is to think about, if you wanted to go get a great meal, and you could either go to a nutritionist or a butcher. Now, neither of them are going to be harmful or intentionally lead you awry, but if you go into a butcher shop and you said, I want to make a great meal tonight, what do you recommend? You're going to get meat. Right? They're going to offer you meat, and that's all they're going to offer you because that's what they offer. That's the salesperson. Again, they're not intentionally trying to give you a bad meal or an unhealthy meal, but a nutritionist has every food choice available to her disposal and is going to recommend what they think is the best nutritional meal to keep you healthy. So that's the difference between a salesperson and an advisor. Now, you may be wondering, how do I know? Again, I would say the best way is when you interact with them. Are they being inquisitive and curious about your life, and beyond just how you want to invest in having a money conversation? A good advisor is going to have a holistic approach and cover probably 90% of the questions will be non-money related, because they understand that without knowing life's intentions and your values, then the money part of it is really going towards a kind of an endless journey of not knowing where the destination is going to be. So that's principle number 2. And by the way, if anybody has any questions along the way, feel free to put the question into chat, I think, Justin, or Q&A, and I think Justin's monitoring that. We can take questions along the way if you'd like. Principle 3, you've probably all seen this or heard this. It's probably on most of your statements, actually, or any marketing brochure has this in the bottom of a disclosure, and that is, past performance is no indication of future results or future outcomes. What this means is when somebody talks to you about making a recommendation, or maybe the neighbor or the brother-in-law, you're at that social event and someone shares with you, I've got this great investment because it generated this past return. It's really important to understand that if you didn't get the return in the past, you missed it. And that past return has nothing to do with the future expectation of that investment or any investment. Another way to look at this is a study, a recap of a study done by Standard & Poor's. And I believe it's over the last 5 years. The far left side of the column is 2017. You've got the blue dots on the top are the percentage of mutual funds that outperformed in the U.S. You can see there's a lot less that outperform. So 342 of them, I believe it was, actually, I can't even see that number. It's being blocked, but outperformed in 2017, a lot less underperformed. So what you might say is, well, I want to just buy those. I want to buy the winners. And what you see in the subsequent years is the number of those ones that outperformed in 2017 that continued to outperform in 18, 19, 20, and 21. And as you can see, the persistence of performance is very low. We know that someone's going to do it. We just don't know which ones. So again, as an investor, it's probably best just to buy everything. I'll actually going to cover that in a principle here in a little bit, versus trying to go off of past performance, because that persistence of whether they're going to continue to outperform dwindles. And the odds of you picking that one that's going to do it is very low as a result. Principle 4 kind of relates to that last principle, is emotions can have a huge impact, or your behavior can have a huge impact on your success. So what you're seeing in the middle of the screen is, imagine the market's going up and you're seeing headlines day after day. You're talking to people and they're talking about how much, how much of a return they've received. It feels very comfortable to invest when things are going well. And emotionally, or just, naturally, we're going to say, well, I want to buy. This feels good to buy. Let's buy into this positivity. And then over time, the markets go through a cycle, and I love the smiley face is turned into a frowny face to a panic face, because that's how we feel when the markets go down and we start to see those paper losses where we're have some loss in our portfolio. We start to question things and we start to get concerned. And then maybe at some point we panic, and that emotion can have a huge impact on your outcome. And this is also why it's really important to have an advisor by your side to keep you grounded and to keep you focused on the plan. And I've seen over my 26 years all too often when clients are engaged with salespeople and something is doing poorly, what they typically say is, well, let's get rid of that. Let's buy this thing because it had a different track record. And that's usually not going to lead to any better outcome, because that's just going to follow the same pattern there. And you kind of always buying high and selling low, which isn't a good recipe. Another key piece of data that really illustrates this idea of emotions. This one is done by Morningstar, one of the largest research firms in our industry. And the dark blue line is the return of mutual funds. Equity mutual funds on the top part of the screen, bond mutual funds on the bottom part of the screen. And the light blue line is the actual return of the investors in the mutual funds. The investors actually return less than the return of the funds. And this is over a 10-year period. And the reason is most people don't hold those funds for the entire length. They're buying and selling during that 10-year period. So therefore, their return ends up being a lot lower than the funds themselves. If they were just to be, I always see, if they were just Rip Van Winkle and, purchased it, fell asleep and woke up 10 years later, they would have done a lot better, because the emotions come out of play at that point in time. Any questions or comments you want to add to this, Justin or David?
Yeah, I mean, to me, and we haven't had any questions come in yet, so feel free to do that. But I kind of envision this as, you're sitting in traffic in the one lane and it's all blocked up, but this lane is going next to you. And, obviously you're feeling stuck. You say, all right, that lane is clearly doing much better. You finally work your way into this lane, only for that to slam on the brakes and then this lane to start going. And that's kind of what we do with investments. I mean, we maintain that diversified portfolio. So just because one thing isn't going, we don't want to abandon it as long as it's a sound strategy. And so as long as that you have the plan, starting in principle 1, you know where you're going, you know what you're building, and you've got the strategy to reach it, you stick to the strategy and not try to change midway. So that's kind of what's coming to my head as I envision what we're talking about right here.
Yeah, it's a great picture.
To build on that. Yeah, and just to build on that, Justin, it's being able to emotionally stay with it, and that's where the advisor comes in. A lot of our job is just helping people get through the ups and downs of the marketplace. In 2022 wasn't a great year for performance, no matter where you invested your money. But the answer wasn't in September of let me get out, or as many commentators were saying on TV, put all your money in a mattress and run away. Because then, of course, the definition becomes, if you're going to take all your money out of the market, it means you're going to miss when the market begins to go back up again. And, you got to be in it to get that gain. And that's exactly what we saw. We saw the markets go down for the first 3 quarters of 2022. And even though the numbers for 2022 as a whole were bad, the fourth quarter was good. But of course, it was only good if you were still invested. And that goes back to Steve's slide. Why is there a gap here? It's because when things get bad, a lot of people run away.
Yeah, that's a great point. I kind of wish I had a slide to show something, because what you see when you look at the data is some of the best performing days come right after one of the worst performing days. So imagine, you're trying to get in and out. if you missed that best day because the prior day was bad, you probably didn't buy in because the market's doing so bad. So what happens is your money's still on the sideline and you miss those best days. I'm sure Justin or Dave could get you that slide if you needed it later. Okay, let's move on to principle 5. Again, ties into all this here, and that is don't turn a temporary loss into a permanent decline. So the sketch here is, if you're somebody, you go to a movie and you get that scary scene, the inclination may be to close your eyes or run out of the theater just because it gets scary. Same thing when it comes to investing. So again, some data to support this. These are historically the bear markets in the U.S., right? Most recently was the 2020 bear market that was down almost 20% in a 4-month period. It would have been easy to maybe to Dave was mentioning just to get me out and I'll wait for it to come back. Well, what often happens is that a comeback happens fairly quick and right after the decline. And you may still be waiting for that decline if you didn't get in April of 2020. And so that decline of 20% was recouped back to zero 3 months later from April to June of 2020. So again, when you sell in those scary moments, you may be locking in those losses because it's very hard because you would need a really good crystal ball that tells you ahead of time before those drops happened. So usually for most of us that can't predict the future, by the time we realize it's scary, we've already seen those paper losses. And it's key principle is be careful of selling and locking in that temporary loss and making it a permanent loss for that time period. Which ties into this, principle 6. Sometimes the best thing to do is nothing. Right. So again, this is where an advisor has a huge role. What I don't want to suggest is we don't have conversations, and the idea that we may get emotional is something bad. I mean, that's what humans do. We are wired to react emotionally, and we need to have conversations to understand why things are happening and to put into perspective the decisions that we can make. And after those conversations are had, oftentimes some of the best thing to do is absolutely nothing. And again, it starts with, did you have a plan to begin with that factored in what markets do and what investments do? Because investments do go up and down in the short periods, but historically investments the markets have gone up over long periods. The markets have not gone down over the last 30, 40, 50, 60 years. They've gone down in a short period of times, 1, 3, and 5, 10-year periods, even 20-year periods. But the longer you hold the investment, the data shows that markets reward investors for participating in the markets. This is always a fun one to talk about, and I may get some questions here. So principle 7, be an investor, not a speculator. Analogy here is if anybody's ever, well, I guess a lot of you are on East Coast, so you might have Atlantic City. I was going to use Las Vegas, but you got Atlantic City there. Would you rather be the casino or the person walking into the casino hoping they were going to get a return that night? Because they keep building casinos. So I have a feeling casinos are winning that question. And when you are that gambler trying to predict which things to buy versus buying everything, you're hoping for a return. You're hoping you're going to be right. Whereas if you could be the casino and own every number on the roulette wheel, you're going to win more often than not over time against the speculator. And that's what a good investment portfolio looks like. It owns everything. It owns, a great portfolio would own probably close to 10,000 companies diversified across 40 to 50 countries amongst 20 to 25 currencies. Own everything and you'll get the return of the global markets, just like the casinos get the return of all their games. Will somebody occasionally win? Absolutely. But consistency and over time, the casinos are clearly winning and the markets also win. That's why those casinos are keep building more more of them, and they get larger and larger. David or Justin, any thing you want to add on this concept?
Steve, this is one of my favorites. I've done presentations on this because I always start with the question, when you go to Atlantic City or Las Vegas, what are you looking to do? The average person will say, well, I'm looking to gamble. I say, but interesting. Do you know what business the casinos are in, whether it be Sands or Bally's or Caesars? You know what the business industry that they're in? They're not in gambling. They're in gaming. And the difference is gambling is you're hoping for a return. You're looking to beat the odds. Gaming is you understand the risks, you manage the risks, and the odds are in your favor. So as an investor, you want to think like a casino. You want to say, I want to manage the risk. I want to understand the risk. I want to manage the risk. And I want to get the odds to work in my favor. But most investors invest like gamblers, and they go in and they just randomly pick different stocks that they like, much like a roulette player might pick a color red, or their favorite number is 22 or whatever it might be, and they hope for a return. So we try to work with our clients to get them to think like the casino, not like the gambler.
Yeah, I mean, I love that analogy, and just the expecting a return. I mean, leaning on the academic research, investing in a strategy and expecting a return like the casino does. They expect at the end of the day, because the odds are in their favor, they're going to win. They know not every hand they're going to win. They know they're going to have to make some payouts to some people. But an investor or a gambler stays in there long enough, they're going to lose. The casino is going to win. Much like an investor in a sound strategy, you stay there long enough, you're going to win. Yes, there's going to be some volatility. Emotions might get in the way there. So to have a professional, but if you stay in long enough with the right strategy, you're going to win at the end of the day.
Yep. Yeah. Excellent. Yeah. So we say the next time you're at a cocktail party or somewhere, and that one person is just bragging about how good they did with their investment, you've got those people roaming around Atlantic City, but once they go back over and over and over again, they usually lose more than they win. So yeah, I love it. Expecting the return versus hoping for it is so important. Again, another way, some data to back this up. So this is actually looking at, again, another Standard & Poor's study over the last 10 years, 4 different asset classes. So and it's looking at all of the mutual funds. So these are professional managers, professional investment managers, not you and I, not just the everyday person, but these are professional money managers running mutual funds for US stocks, international stocks, emerging market stocks, and intermediate US government bonds. Over the last 10 years, this is how many of them actually beat their index over the last 10 years. They're all gamblers. They're the odds of gamblers. Actually, gambling has better odds than 14%, 20%, 20%, and 14%. And the really disturbing thing here is that return of the index is there for the taking for anybody that wants to invest and get the return of the index. But the allure of wanting to beat the index or beat the market tempts so many people to hire these active professional managers. And unfortunately, they end up with these results that they tend to underperform what the market was giving them if they just participated. The last foundational principle is almost as important as the first one of having a plan. And that is, when investing, it's important to have an investment philosophy. And essentially what this means is know why you're investing and know why you should expect a return. And if you have an investment philosophy, it actually becomes easy to stick with. Number one, you know where you're going, but anytime somebody throws an idea at you, like, hey, you should invest in this, or why do you do that? You can actually take those ideas and kind of overlay them to your philosophy to see if it fits, right? So if somebody comes to you and let's say your investment philosophy is, I want to make sure a component of your investment philosophy may be, I want to be diversified. I don't want to be so concentrated and exposed to any one company risk or any one event risk. I want to be diversified. And someone comes to you with an idea that's like, you know what, you should really put a lot of money in, XYZ stock. It may be a great story, great idea, but you can take that concept and go, does that fit within my investment philosophy? And you would say, it doesn't. I want to be diversified, which means I'm going to own that stock in a diversified portfolio versus taking a huge overweight or allocation to that one company because it doesn't fit my investment philosophy. So kind of to sum it all up, like here's the investment philosophy that we share at Buckingham, and I know that Justin and David share alongside with us. And it's pretty prevalent in the industry today. To wind the clock back 20 years, this investment approach, which is heavily rooted in academics, not Wall Street, but academics, was in its infancy stages. But this evidence-driven investment philosophy has 5 key pillars to it. First one is markets are highly efficient, which is why some of those statistics we saw earlier on the ability for people to beat the markets or beat the indexes is there. Markets are so efficient, it's hard to outguess them consistently to beat the market. Pillar number 2, risk and expected reward are related. The idea, I grew up in the Midwest, and I was taught at a young age, be leery of the free lunch, or be leery of the thing that's too good to be true. If you want a higher expected return, you're going to need to take more risk. The idea of reduce my risk but increase my return, unfortunately, isn't there typically. So risk and expected return are related. Third pillar is that diversification is essential. We have to diversify and mitigate company specific or event specific or time period specific risk as much as we can. And Harry Markowitz, which is one of the Nobel Prize winners of the 51 Nobel Prize I mentioned earlier, he said diversification is the only free lunch when it comes to investing. You can buy everything, you can actually own everything at no extra cost, so you might as well do it, and that gives you diversification. Pillar number 4 is we should all be pursuing the factors of return that drive higher returns. Certain companies, like small companies, are riskier than the big, large established companies. And historically, those smaller companies have outperformed those large established companies because they're riskier. Distressed companies or low-priced companies, which are often referred to as value companies, are riskier than growth companies. That's why they're lower priced relative to their book value. I mentioned Warren Buffett earlier. He's built Berkshire Hathaway on value stock investing. He's looking for companies that are priced low relative to what they're actually worth on their book value statement. So understanding where different factors of return are within the marketplace and making sure you're exposed to those factors of return are instrumental to getting the return that's probably necessary for your plan. Then the last pillar is focus on what we can control. Go back to that behavioral concept. What can we control? If the markets have dropped and you see a temporary loss, we can't change that. But what we can control is our actions going forward and in managing those behaviors and managing emotions.
Steve, we got an interesting question here that kind of relates to the diversification topic, owning everything. And the question is, should cryptocurrencies be held as a small portion of a portfolio to technically own everything?
So that is a great question, because the question could be, is a cryptocurrency itself, is it an actual investment or not? So the traditional definition of an investment is something that generates a return and an earnings, because when you have earnings, you can calculate an expected return. A cryptocurrency itself does not have any earnings, so you can't calculate a return. So it would probably not be defined as a traditional investment. A cryptocurrency would be probably classified as more of a speculation. Like you're speculating on where the price might go based on supply and demand. So to directly answer that question, I would take it out of an investment portfolio. What I'm not saying is that you should not own it, but that's because I think it's a different conversation or decision-making process. For example, I grew up having a baseball card collection. And because I thought that the price of certain cards and certain players would go up over time because their popularity, I would kind of lump cryptocurrencies or any currency into that category. art would be something else. So there's a lot of things that don't generate earnings that might go up over time based on supply and demand. So that's where I look crypto. Now, companies that are mining for crypto or with all the technology behind that those are investment companies. Those are companies you might want to probably include. And if cryptocurrency becomes even more popular, et cetera, you would hope that the popularity and growth of crypto would translate to more earnings of those companies that are doing blockchain, et cetera. So make sure you own those companies, absolutely, because those are investments.
Yeah, thanks, Steve. And this is really interesting, getting my certificate in blockchain and digital assets to really answer the questions that were coming in. And it's funny how we were getting our peak questions on cryptocurrencies as the price was reaching its peak back towards the end of 2021. And obviously through 2022, like everything else in the market, it fell drastically. And as the price kept falling, we got less and less questions about whether or not people should be, owning cryptocurrency, which I thought was highly fascinating and goes exactly to the principles that we're talking about here. People want to be owning things when there's excitement, things are going up. But when things are going down, people are less likely to be talking about them. What I would say specifically with cryptocurrency is that, even on this slide, risk and expected reward are related. The problem is we don't know the expected reward of cryptocurrencies.
Correct.
Because they haven't been around long enough. We don't know. We do know the risk. And if you're willing to accept the risk, then you can accept whatever speculative reward that you want to imagine. But the risk with cryptocurrency, owning it directly, is it goes to zero. So if you're comfortable with that risk, and some people are, then sure, take it. But in terms of a academic-based investment portfolio, cryptocurrencies as they stand right now are not involved with that. There's a side piece, and whether you should own them or not is a separate question. But as part of your long-term investment strategy, right now, based on the academics, that answer is no. That could change in the future. But Steve, exactly what you were saying, I agree with.
Yeah. Again, a lot of us have, side fund money just to see what happens with it. And I always lump, crypto and these speculative things into that category, that if it intrigues you enough and you got to scratch that itch, put some money there, but not so much that if it does go to zero, it changes your lifestyle. That's kind of the advice I give there.
And the other way I look at it, Steve, is I always look at it that as crypto becomes a bigger part of our economic fabric, it becomes part of the S&P 500, it becomes part of the Russell 3000, it becomes part of all the companies that we're already invested in. And much like the question we get when gold prices go up or when oil prices go up, should I invest in gold, should I invest in oil? Recognize you already have exposure to those things through the companies that you're traditionally buying. The question you're really asking is, should I overweight gold? Should I overweight oil? Should I have more of that than the rest of the market? And when you ask the question about cryptocurrency, I'd say it's the same thing. Should I own more cryptocurrency than all the companies in the US own as a proportion of their books? And when you ask the question that way, it changes the answer that you might get.
Yeah. Great point. So you may be wondering, okay, these are, intriguing principles, and I often hear like they sound common sense, right? Oh, well, of course, I hear that all the time. Like, I didn't get any lightning. Now, what a lot of people have to reflect on, they go, you know what, although these are common sense and they seem obvious, they're very hard to stick with. And that's where taking some action with these come into play. So as I mentioned earlier on, this principle one, everything starts with a plan. This is an example of 5 categories of probably every one of our lives that we think about, right? We probably all have an idea of our future and a vision for what that looks like. We all probably have some thought around balancing our work, right? Our purpose and our lifestyle. We all probably have a definition of what financial comfort means to us. That's going to be different. We all probably think a lot about our family. It could be aging parents or children or grandchildren and the impact we can make there. And a lot of us probably think about our legacy. And then within each of these 5 areas of life, here are just 3 examples per, which means there's 15 conversations that probably need to be had either with your family or with an advisor that should make up your plan, which ultimately the investments are going to be geared towards making sure that plan has a high probability of success. So from an actionable standpoint, as this is on the screen, maybe there's some topics here that you're like, you know what, I've never had that topic with David or Justin or my advisor today. And I need to have that conversation to get my thoughts on the table so that we make sure that these areas are accounted for in the plan so that we don't have a surprise down the road.
Yeah, definitely. And it's funny you mentioned that too, because that's what this webinar series that we've been doing over the past year now, once a month, is really built towards. So we've done 12 plus webinars now because it's been over a year. And only a couple of them have been actually focused on investments. Others have been focused on other areas of the financial planning process or of lifestyle. I mean, even the next webinars that we have lined up, I'll take actually a quick second because it relates exactly to this. What we want to be talking about there. The next one, April 5th, we have John Walsh coming to join us. And he is a decluttering and downsizing expert. So when you talk about assisting parents, essentially, if they're aging, looking to downsize, reduce their home, he is an expert in coming in and helping them declutter and downsize their home. So that should be an interesting webinar we have there. And then in May 10th, we have another panel session like we did last month on divorce, except this is focused more on real estate. So we'll have an agent, we have a professional appraiser, and also a loan officer to talk about the real estate market, where it is, and what you should be looking at if you're looking to get into a home. So those are other things not directly related to your investments that we want to make sure to help out with. David, what else do we touch on this life map here?
Depending on the client, probably everything.
Yeah.
And reality is our clients, most of them have been with us for many, many years, and those that haven't will eventually be with us for many, many years. And during the many, many years, there may be a time where we're talking about assisting their parents. And then a couple of years later, we may be talking about assisting their children. And it's somewhere along the way, we have to make sure that we're managing for their own health. And if there's 15 boxes here, probably everybody touches on 10, 11 of them at some point in time.
Right.
And they're not financial, or at least tangentially are financial.
Yep. Exactly. Yeah. Actually, none of these are going to be investment related, but when you have a solid foundation and you have an investment philosophy and you know where you're going and you're expecting a return, it actually gives us the peace of mind and freedom to start thinking about these other areas of life and how we need to plan for those as well, so that we don't get surprised. So again, just to summarize it up and wrap up, those eight foundational principles. Make sure everything is a plan, right? And you're revisiting that plan on a regular basis. Make sure that you're working with an advisor. And if you are with a salesperson, just understand what their intentions are and what their skill set essentially is, and what they can draw from to help you with. Really important to understand that, when you hear about someone's return that they got, which is backwards looking, there's no indication of how that investment's going to do in the future. Your behavior might be the most important piece of whether you're going to have success, but it definitely can impact your success as an investor. When you do encounter the short-term loss in your portfolio, and it will happen, investing is short. Again, it goes up and down the short term. You will see a loss at some point in time. It's important not to lock that in and make it a permanent decline. Sometimes the best thing to do is nothing, but it probably involves having conversations and discussions so you know your options and gaining perspective on what's happening and what to expect going forward. Be that investor, be the casino that's in the business of gaming versus the gambler, and have an investment philosophy, understand and make sure it resonates with you, and then stick with it. So again, thanks for hearing about the book and the 27 principles. I hope you enjoy it. I hope it intrigues somebody in your life, either you yourself or somebody else, that says, this looks interesting. I want to take a look. And the pictures, the short stories, and the quotes, hopefully it'll plant that seed that somewhere down the line builds that shady oak tree that gives us some comfort during those hot, steamy days of when the markets give us stress. I'll turn it back over to you, Justin and David.
Yeah, thank you so much, Steve, for joining us today. I want to let you get out on the slopes today. I think that's part of your plan. So, and let everybody get back to their workday. But thank you so much for the education of the 27 principles. We do want to make sure we're going to get a copy out to you. So if you don't have a copy yet, we will get a copy out to you either through Sherpa or Personal Wealth Strategies. For those live attendees on the webinar, we'll be able to keep track of here, and we'll be reaching out to you to get the address where we should send the book if you do not already have a copy, because we want to get this in your hand, all 27 principles, not just the core 8. So thank you so much, Steve. We just have no more questions. They're just saying thank you for the insights, and thank you. So I'm all good here. David, any final before we let Steve run out?
Yep, Steve, thank you very much for informative and concise presentation. You spoke just like the pictures.
Thank you for having me, and enjoy this. And again, thank everyone for taking the time to spend some time with us today and learn about the book and the concepts.
Amazing. Thanks so much.